This is Brad Wolff, and this is the end of day Emini review for August the 18th, 2022. The day was an overall broad bull channel that typically has a lot of trading range price action here, and it's not all that clear that it's a broad channel until most of the day is already over with. Arguably, you didn't know it was a broad channel until the very end of the day. So on the open, big bear bar, two big bull bars, trading range open, bears will sell below, bulls will buy above. This bar was a bit of a surprise, so odds favored a second leg down, especially after this bad buy signal bar here that did not trigger. Some bears will sell, betting on a bear breakout below this double bottom, or you can also say it's a double top. And those bears hope for a measured move down. Those bears that did sell, they'll buy here, and they'll buy back shorts. Some bears will buy as it turns up. Aggressive bulls will go long here. They'll be disappointed by the follow-through. Consecutive bull bars fail to break above the moving average. It's testing this close back up here. Some bulls bought more lower. This is, again, another sign of a trading range. Some bulls will exit below, and if they did, and they're trading always in, and they believe it's always in long, they would buy again above this bar or this bar. Some bulls will hold below. Bears that sold get out probably somewhere up here if they did not get out as it turned up. So bulls are long. They probably get out below this bar. It's 4 consecutive bull bars. It's a wedge, as you can see here. It's a higher high double top with this high or this high. But the problem the bulls have is you're buying at the top of the trading range, and the risk is big. All the way down here, maybe here. Even if the market sells all the way down to here, the reality is it's a trading range. So bulls are going to buy down here, and the market's probably going to go back up to here. So a lot of bulls would rather get out and look to see the pullback and maybe buy above this bar or this bar. Difficult to buy here. You can, betting on a wedge, 1, pullback, 2, pullback, 3. So some bulls buy, other bulls buy here. Some bulls will buy the breakout to a new high, but they'll be disappointed by this rally. It's a wedge, 1, 2, 3, multiple attempts up, and eventually those bulls are going to give up and start to look to buy lower. And the problem with the trading range is often the pullbacks are deep, and they retrace most of the pullback. The reason for that is bears sold here, they sold below here, they sold this high, and they scaled it higher. And they're confident that the market's going to retest their entry prices. And if you just look at this sell-off, look at everything it tested. It tested this low close. You could have tested this low, any of these closes here, this high. That's very typical of a trading range. Bulls were hoping this was a bull flag. However, trading range, 3 pushes, 1, 2, 3, or 1, 2, and 3. A lot of bulls will give up below these bars and get out of longs for the simple fact that, again, if the market falls all the way down here, it could still be a trading range. And a lot of bulls don't want to buy the top of what could be a trading range. They'd rather get out early and look to buy lower. So bulls start giving up. Big bear bar, bad follow through, a sign that you're probably going to get a second leg down. However, the second leg may not go that far. It may just test the bottom of this range, which is exactly what it did. It's also a wedge. 1, 2, and 3. You can call it a final flag here. But regardless, bears will sell below. They'll sell the closes here. They'll sell this close. And they'll probably get out above this bar or above this bar. What's interesting to note here is, with it being a wedge bottom, this was not a great sell to close bar. However, some bears will sell. They'll sell more higher. That's 50% of their entry price. In other words, break even. They sold here and higher. Other bears, maybe they sell here and they sell more below here. Those bears that did got trapped on this bar, and the market formed a measuring gap here. And it also formed a measuring gap here, and arguably formed one here. This rally is a problem for the bears. It's fairly tight, and it trapped the bears all the way up. Some bears, yes, they would sell here, make a scalp. Even if they sold here, maybe they make a small profit, but it's not that easy to sell. This sell didn't work. This sell went down 2 legs, failed. This sell, weak doji, didn't really go anywhere. Strong breakout. The bears that sold here got trapped and we formed a wedge. So you can call it consecutive tops, you can call it an endless pullback, or a small pullback trend, even though it's not a trend, it's more of a rally. Either way, for the most part, it looks like a leg in a trading range. Even with the market forming gaps, the biggest issue the bulls had was the market was not above all the bars to the left. So when it did get above the bars, it stalled, it formed a second entry, and sold off into the day. The last thing to comment is in a trading range, in a broad channel, they're both the same. Wedges are common here and here, as well as parabolic wedges. And here's a wedge. And there's a wedge up here and down here. And they typically reverse. If you enjoyed this video, please go to thebrookstradingcourse.com where you can see more of these blogs or find more information about the trading course. Thank you for watching.